Right now, a quiet but absolutely massive crisis is unfolding all around the globe. It's this invisible crunch that literally has the power to completely reshape global supply chains. But somehow, it is flying totally under the radar. We're talking about silver. Welcome to this explainer. Today, we're going to break down exactly what the data is telling us about this rapidly draining commodity, who actually stands to profit from it, and what it all means for global wealth.
Now, to really grasp why this matters, we got to look at the stakes here. We are tracking market dynamics that could realistically boost certain stocks by a staggering 150 to 300%. I mean, the leverage in this sector is just massive. Despite these enormous potential returns, mainstream finance is almost completely ignoring the fundamental math that's driving this entire setup.
And because this is happening completely by stealth, we're seeing billions of dollars quietly being transferred between countries and industries right under our noses. Wealth is quite literally shifting based on who controls this physical resource and who desperately needs it. But to really understand this wealth transfer, we have to completely change how we think about silver itself.
See, when most people hear the word silver, your mind probably jumps straight to jewelry, right? Or maybe some shiny old coins. But that is completely the wrong framework. Jewelry makes up barely 10% of actual demand. The real story, the documentary unfolding right now in manufacturing hubs and refineries globally, is industrial silver. This is the raw engine of the modern world, and the current crunch we're seeing is unlike anything we've experienced in 30 years.
Let's look at the seemingly unsolvable math problem we're up against. Global silver production actually peaked years ago, back around 2015. Since then, output from major mines has plummeted by nearly 12%. We're actually losing about 2 to 3% of our supply every single year. Meanwhile, annual demand is surging upwards at 4 to 6%. We are literally pulling less of this critical metal out of the ground precisely when the world needs it the most. So what does this actually mean? Well, when supply drops annually and demand rises annually, you get what economists call a structural deficit, year after year after year. This isn't just Wall Street speculation or some temporary market blip. This is basic supply and demand mechanics. It is pure physics. You simply cannot consume more than you produce forever without eventually breaking the system.
Now, what's really interesting about this is where all this silver is actually disappearing to. Let's break down the sectors. Solar energy is swallowing up a massive 32% of global demand. Electronics and semiconductors, which are being totally supercharged by the AI boom, they take another 23%. Industrial applications, like those massive EV battery factories, they eat up 20%. The traditional stuff, jewelry and coins, is just 15%. The massive, undeniable driver right now is solar. To put that staggering solar demand into perspective, just consider this single number, 168 gigawatts. That is the global solar capacity added in 2023 alone. That's enough to power tens of millions of homes. And here is the real kicker. Every single one of those millions of solar panels deployed globally requires about 15 to 20 grams of ultra-pure silver. The renewable energy transition isn't slowing down anytime soon. It's accelerating. Now, you might be wondering, why can't manufacturers just use something else? Well, unlike copper, which they can sometimes swap out for aluminum if prices get too crazy, silver is completely unique. It has these incredible conductive properties that make it totally irreplaceable in most of these high-tech industrial applications. You literally cannot engineer around silver for EVs, advanced AI chips, or high-efficiency solar panels. There is absolutely no substitute. Which brings us to a really fascinating and honestly critical layer of this whole situation, the global geopolitical chess game. Because when you have an irreplaceable resource running a massive deficit, whoever controls the supply wields enormous global power. Let's scan the global map for a second. Mexico produces 23% of the world's silver, but on the ground there, they're facing severe water scarcity and increasingly strict environmental regulations, which makes extraction incredibly difficult and way more expensive. Next up is Peru, holding an 11% share of global production. But Peru is currently dealing with major political instability. Mine closures are happening way faster than new ones can even open, and all this instability has severely slashed their national output. Then, of course, we have China, producing 9% of the global supply. But here is the massive catch. They aren't sharing. Because they manufacture a whopping 80% of the world's solar panels, China is actively hoarding their domestic silver supply to secure their own manufacturing chain. They know exactly how critical this metal is. And that exposes a massive strategic vulnerability. The United States produces just 6% of global silver. The West is aggressively mandating this huge transition to renewable energy and net zero goals, yet we do not control the raw materials required to actually make it happen. We are entirely dependent on Latin America and China for our technological future.
And in real time, the pressure on the supply chain is just piling up. Governments are quietly buying up strategic reserves. Strict new ESG regulations are making fewer mines economically viable. You might think, oh, recycling could save us, right? But only 15% of silver is currently recycled. And while tech companies are desperately trying to innovate and use less silver per panel, that kind of commercial viability is still a good 5 to 10 years away. Meanwhile, it takes up to 15 years just to bring one single new mine online. Yet despite this massive physical crunch, there's a bizarre financial disconnect happening, and this brilliantly illustrates it: the gold to silver ratio. Historically, this averages about 40 or 50 to 1. Right now, it's sitting way up at roughly 70 to 1. This means silver is deeply, deeply undervalued relative to gold. It has significant upside just from returning to a normal baseline, even before you factor in the massive supply deficit we just uncovered. So what is the realistic investment reality here? Let's trace the physical silver upside over, say, a 3 to 5 year horizon. Right now, all that industrial demand acts as a rock-solid floor around $30 to $32 an ounce. Because manufacturers absolutely have to have it to build their products, that demand won't just disappear even if everyday investors sell. As the deficit worsens and the physical supply gets tighter, the data suggests silver could realistically target $50, $60, or even $80 per ounce. That's a 50 to 100% appreciation, acting as a really powerful hedge against inflation. Then, you have the silver mining stocks. Companies operating in this space offer incredible leverage. If silver prices rise, these stocks could easily see a 150 to 200% upside. But there is a massive catch, and it cuts both ways. They carry intense operational risks, they're highly capital-intensive to run, and as we saw with Peru and Mexico, the political risks in those mining jurisdictions are incredibly high. If silver crashes, these stocks crash much, much harder. To navigate this without losing your shirt, let's look at a practical framework based on your own risk tolerance. If you're conservative, a small 3 to 5% allocation to just physical silver offers a low-risk wealth preservation strategy. A moderate approach blends that physical silver with some mining stocks for a medium-risk, diversified exposure. And an aggressive approach heavily overweights those volatile mining stocks for high reward, but that's assuming you do deep research on those operational risks. Just as importantly, here is what you absolutely should not do. Do not panic buy at peak prices. Never allocate more than 10% of your total portfolio to this space. Do not ignore the massive political risks associated with these mining companies. And most importantly, do not try to day trade this trend. This is definitely not some get-rich-quick scheme. It is a slow-moving, structural, tectonic shift that unfolds over years, not days. Look, history consistently rewards those who can identify these structural commodity shortages early on. Those who saw the constrained supply and rising demand in oil in the early 2000s, copper in the late 2000s, and lithium in the 2010s, they made significant returns. The data strongly points to silver being the next great structural shortage megatrend. The global silver crisis isn't some well-kept secret. It's just completely invisible to people who don't know where to look. We're rapidly transitioning to a highly electronic, renewable world, and we are literally running out of the primary metal required to actually build it. When supply is physically constrained and demand keeps rising, the math is totally undeniable. Thanks for joining me on this explainer. The only question left is, will you position your portfolio before the rest of the world finally wakes up?